Taxes in retirement. If you're a pre-retiree or a retiree, you have a lot to think about. There's a lot of mistakes that can be made. There's a lot of advantages for you inside the tax code. And in the last few years, we've seen a lot of changes. We've seen TCJA, Secure Act 1.0, 2.0. You don't need to know what everything is, but that is hundreds of pieces of legislation that can complicate and confuse your tax situation. Today, we're going to talk about, number one, just how taxes work. And then number two, and more importantly, talk about some things you might want to be thinking about as you roll into retirement. And I'll give you some actual examples, because that's what people tell me, is that the actual examples of what we've done for our clients are the most helpful when doing these videos. So number one, let's kick it off with talking about what I see as a major problem. And this is no secret. You know this. The problem is the national debt, the U.S. debt. If you go to, I don't remember the website, you can Google it, but usdebtclock.com or something like that. That'll keep you up at night, watching that number increase rapidly second by second. But this is what the debt looks like. I think we're around 35 trillion or something. This is not a number I follow closely because it kind of scares me, but I think we're around 35 trillion in national debt. On the right, this is important for you to know. That is your IRA, your defined benefit plan, your pension plan. All of us combined in the United States, that is the trillions of dollars that we have in our retirement plans. Why is that important? Well, because if I'm the government and I've created the problem in the graph on the left, and I know that all of us individuals, all of us Americans have these account balances on the right and they're taxable, I may want to consider tapping into those accounts in order to solve for my deficit and for my massive amount of debt that I'm accumulated. Now, why am I here? What do I do? I'm going to talk about myself more in a minute, but what's really important for this presentation is the IRS tax code is something like, 7,000 pages. Who knows how big it is? But inside of the tax code, there are little treasures. We have to find them. The IRS isn't necessarily going to tell us about them, but there are little treasures that I like to point out for folks, especially retirees. And then there's rocks. So what is a rock? That's something that drags us down in retirement. And this is a little video. This is Family Guy. If you don't know it, it's the Griffin family, and Peter's the dad, and they hike Mount Everest, and they're coming back down, and they find a couple folks who have fallen in a crevasse. And Peter is great dad, good dude, so he has his family lower him down with a rope to save them. And here's the result of this.
Peter, we can't do it! You're too heavy!
Keep going, you're almost there! I found a rock I like.
He's got a rock there. He brought that rock with him in his retirement. We don't want to bring rocks with us through retirement. So I'm going to show you some rocks that we're going to try to avoid. And again, some treasures that I'm going to point out to you. So a little bit about me. I started this company, Hoffmeyer Wealth Management, back in 2008. I'm a certified financial planner and certified estate planner. And I am fortunate to own this company with my wife, Kelsey. She's the VP of Client Experience. She had over a decade in the financial industry before she joined me on my team. And so that's a great relationship. Most of the time, she might say otherwise, but I think it's a great relationship. A little bit about us on the personal side, trip to New York. We love to travel. I'm restoring an old Bronco. I like to play hockey. That's a picture of me playing hockey at Coors Field a few years ago. And that's our pup, Marlo. He's our office dog, our office mascot. Our team. Here's what our team does. Great folks, hardworking folks. And on the right, we have Jackson and Eli, our chief dog officers, our CDOs. But here's what our team does. We take all these complexities, all these things that retirees are thinking about. Retirement planning, cash flow planning, tax planning, estate planning, gifting, giving, all of these things. And what we found is when people come into our office, it's just they have this scattered thoughts about all these different things. And then we bring it all together. And I show this slide because we're not going to focus on all of this today, but it is important to know what we do as a whole. But we are going to focus down at the bottom left. Tax. We're going to talk about tax, and let me dive into some disclosures. I'm not going to do your tax return for you. I'm not going to write your will. I'm not a CPA. I'm not an attorney. What I am is a certified financial planner, certified estate planner, and a strategist. So everything we do for our clients, we are talking about the after-tax implications. The moves we make today, how is that going to affect our taxes not only today, but next year, 2 years from now, and 20 years from now, and when we pass our assets along to our beneficiaries? How are we going to leave our legacy in the most tax-efficient manner? All right, taxes 101. We need to understand the tax code in order to make educated decisions about our money. If you already understand the tax code, go ahead and skip forward to Taxes 201. That's where we're going to talk about strategies. But if you don't have a great grasp on how our taxes actually work, and I find that most people, even if they think they do, they don't, stick with me here. Taxes 101, we're going to talk about what I call 7 pool money and 3 pool money. The reason I call them pools is because if you think about your backyard, you're going to design a pool, and it's going to be a really expensive one. It's going to have different tiers, different pools. That's where our tax code works. We're all familiar with tax brackets. Well, they work kind of as pools. So when that initial bracket fills up, the 10%, the 12% bracket, whatever it is, and the water trickles down to the next pool. When that one fills up, it trickles down to the next pool. So I'm going to refer to this as 7 pool money and 3 pool money. I'll explain the 3 pool money more in a second, but I think it's easier to think of it as pools as opposed to just tax brackets like we're used to. And then we're going to talk real briefly on deductions and credits and kind of the similarities and differences there. So again, here's our problem. And to dive a little bit deeper into the problem of massive national debt mixed with massive amounts of money in our IRA, let's look at historical tax rates. It looks like this. This is from the St. Louis Fred, which I believe is going to be your most accurate source. This is a government website, so just a great resource for government statistics and financials. If we look, this chart goes back to prior to 1920, but this is historical tax rates. So if we look at World War I era, we had the highest marginal tax rate was over 90%, and then we fast forward a little bit to today. 2018 is when our most recent tax brackets came out, so we are still sticking with that as I record this in 2024. They're set to expire at the end of next year. We'll see what changes now that we are post-election. So the highest marginal tax bracket right now is 37%. So historically, we're about in the middle or maybe on the lower end there. Couple quotes. I'm going to ignore the one on the left, focus on the one on the right because it's a cool song that you might know. Let me tell you how it will be. That's 1 for you, 19 for me. Should 5% appear too small, be thankful I don't take it all. You may, if I sang it, you probably would know that song, but I'm not going to sing it because no one would appreciate that. Who was that? That was the Beatles. That was George Harrison in 1966. In 1966, there in Great Britain was a tax rate of 95%. So if you do the math there, for every $100 they made, they got to give away, they were forced to give away 95 of them, and they got to keep 5. That's why they wrote that song. Recent tax laws, like I mentioned, we have TCJA, that was 2018, and don't miss out on that because it continues for a couple more years, and it may, now that we're post-election, it may get extended beyond 2025. Taxes are kind of on sale right now. So there's some strategies that you may want to look into when considering the fact that taxes are a little bit lower than they typically are right now. Secure Act 1.2, followed by the CARES Act that came out right after, and then we had Secure Act 2.0. What you need to know here is this is just hundreds of pieces of legislation. You don't need to know all of them, but you do probably want to seek some professional advice because there may be things for you to take advantage of or things that you want to try to avoid. All right, let's look at our brackets, or like I said, our pools. 7 pool money. This is our ordinary income, so it's pretty simple. We know how this works. We have a 10%, 12%, and then going up to 37%, the highest marginal bracket that I mentioned. And here's a question for you, a little bit of trivia. I've given this presentation in front of a live audience, I don't know how many times, the last probably 6 years or so. And half the people get this right, and half the people get it wrong. So marginal tax rates, what does that mean? Well, marginal tax rates that's the rate that our next dollar of income falls into. So I'll go back a slide here. And let's say I'm the CEO of the company here, and I'm making $201,050. And we've had a good year. It's November right now, and I go into Kelsey's office and I say, hey, I think I deserve a raise because I worked pretty hard this year. And she takes that back to the team, and they come back the next day and they say, you're right. We are going to give you a raise because you've done a great job. We're going to give you a raise. Here's a check for $1. So I've now made $201,051. So I've gone from the 22% to the 24% range. Is that going to have a big or a small impact on my return? Again, half the people get this right and half get it wrong. It's going to have a small effect because it's only that additional dollar that's going to be taxed at 24%. All the other money is going to hit that 22, 12, and 10% bracket. That is the beauty of what's called our progressive tax system, and that's the concept of marginal tax rates. 7 pool money on a staircase. I like to represent it this way because it's much easier to follow than looking at data in a table. And some things to point out here. We have our 10% bracket on the left all the way to our 37%, our highest marginal rate on the right. But look at this. There's a couple arrows, and these arrows represent areas where we have a large jump. So 0 to 10, that's a big jump. 12 to 22, also a big jump. 10 to 12, not so much. 22 to 24, not so much. What does that mean? Why is that important? Because that shows planning opportunities or pitfalls. If we're already in the 22%, maybe we just want to run that out all the way to the end of the 24%. Or maybe we are in the 12 and we're about to hit the 2022. Maybe we want to make sure that we don't go into the 22. So I like that graphic. It's a great way to really visualize our 7 pool money, the way our tax brackets work. Dividends and capital gains. So this is different. This is 3 pool money. Income is taxed as 7 pool money. Dividends, capital gains, that's going to be different. If it's qualified dividends, unqualified dividends, not the case. We're not going to go into that today. So the way this works and what causes capital gains is we just bought something, whether it was a stock or a rental property or just something that we bought as an investment and it made money. That's going to be taxed as capital gain. And I'm going to cruise through this slide because I want to get right into my staircase for this, but this is our 3 pool money. Capital gains, 3 pools, 0%, 15%, 20%. It's a little cleaner, especially when I put it on the staircase. Our 0% runs up to about $120,000, $130,000, and that's if we are factoring in our standard deduction, which we'll go into several slides from now. But what's important to know about this is these work in tandem. 7 pool money, 3 pool money. And there are ways sometimes, as long as we keep control, that we can have our income come from 7 pool or 3 pool. 3 pool typically is going to be a little bit of a preferential tax treatment. So I'll give you some actual examples of how we've been able to do that with clients who we work with. Deductions and credits. Here's what you need to know about deductions and credits is credits are better. Credits are a dollar for dollar refund. So if you had a $1,000 credit and a $10,000 tax bill, you now have a $9,000 tax bill. A deduction, on the other hand, if you had a $10,000 deduction, you're not necessarily going to get, and you had a $10,000 tax bill and a $1,000 deduction, you're not necessarily going to get that entire $1,000 back. In fact, you're not. That's just going to be applied to your tax bracket, and that's the amount you're going to get back. I understand that's kind of confusing when I put it into words like that, but here's what you need to remember. Credits are better than deductions 10 times out of 10. So going back to the staircase, here's an important shift we need to understand. One of the biggest deductions we all have available is what's called the standard deduction. The standard deduction moves our staircase and our pools a little bit to the right. So what that means is even though there is no 0% tax bracket, if we look at the numbers here, 65-year-old married filing jointly, you can make up to about $30,000 and pay 0% in taxes. If you had nothing going on, that's because you automatically get about a $30,000 deduction. So you make $30,000, you get to deduct $30,000 for doing nothing, and you pay 0 in tax, all things being equal. As I move through this, I just want to point out everything I talk about today is going to be married filing jointly, and all the scenarios are going to be for folks who are 65 or older, because you do get an additional deduction for being 65 and another one for being blind. We'll talk more about that later on. All right, let's look at our credits. So credits, are they better than deductions, or are they worse than deductions? They're better. Remember, that's one of your big takeaways. Credits are better than deductions. And this is what I put in 2 treasure chests here, because credits are awesome. Dollar for dollar return, money in your pocket. What do we get credits for? Healthcare tax credit, earned income, education. Say these are just a few of them. Child tax credits. Another one that's not pictured here is EV credit. So all of these things, they also have some qualifications. If you make too much money, you're not going to qualify for a lot of these. But if we slap all this on a simple tax return, deductions and credits, example of putting all this together, they made $40,000. And what happens? Well, we have that deduction I told you about. So the numbers for 2024, they get to deduct $29,200, and they're over 65. So they get an additional $1,550 times 2 for a total deduction of $32,300. Then they're low income earners and they put money into an IRA. If we put money into an IRA, we know that we get a deduction. So that's another deduction we're going to tack on top of it. So now our income has gone from $40,000 down to $5,700. Times 10% would be 5, which is the tax rate this hypothetical couple hit. $570 in tax due, but they got a credit for $1,000 because lower income, put money in an IRA, they qualify for the saver's credit. So that basically wipes out any tax due. So that's a $40,000 couple that's paying $0 in tax. Now you're looking at that saying, well, they owe $570 and they have a $1,000 credit. Shouldn't we get money back? Nope, not in this. This is not a refundable credit. Some credits are refundable, some are not. But regardless, $0 in tax. Pretty cool. All right, so that's it. We're going to dive into 201. This is where I'm going to show you some examples of ways that we can help people, things that you can take with you, and if it makes sense, maybe apply it to your own situation. Again, with the disclaimer that we always recommend talking to your attorneys, CPAs, tax preparers. We're just talking general here because your situation may not match up exactly with our clients, and odds are it doesn't, because everybody's unique. But what we're going to dive into here is this list here I actually have on the next page here. So what the real tax system looks like, because it's not as simple as my 7-pool and 3-pool money. What it looks like is, time for a coffee break. We have RMDs. That's a question people are always confused about, RMDs, and everybody's afraid to miss them because we get penalized, and those rules have changed recently. And then we throw in capital gains. How does that affect other things like Social Security taxation? We're going to look at Social Security benefits. Is your Social Security taxable? Yeah, probably. Most of the folks we work with, I'd say 100% of them actually, taxable Social Security benefits. Medicare premiums. There's spikes in your Medicare premium, in your Part B and your Part D premium. So we're going to dive into that, what triggers that. And then something we call the NIT, net investment income tax. Where does that come into play? We're going to spend a small amount of time on that. And the next thing here, alternative minimum tax. We're going to spend almost no time on that. All your takeaway there is it's not an alternative and it's not a minimum. It's mandatory and it's a maximum. So if I were titling this, it would be MMT, mandatory maximum tax, not alternative minimum tax. That's your takeaway there. That doesn't hit, we don't see that scenario come into play very often. But we do have a slide, so we'll go over it. But more importantly, RMDs is a little bit of a rock. RMDs, that's just the time when the government, the IRS, forces us to take money out of our IRAs, and those accounts are called qualified accounts, which is really just under the umbrella of anything that is going to be taxable when we pull money out. There's something like 27 different types of retirement accounts, and a lot of those are going to fall in RMD land here. Or if you inherit an account, even if it's a Roth, that will still have some RMD implications as well. And since 2020, this has become so much more complicated, speaking to beneficiary RMDs. So that's a topic for another day. I'm going off on a little rant there. Anyway, Here's how it works. You take your account balance and you divide it by this distribution period, and this is a life expectancy table that's set by the IRS. We have to start this when we're 73 as of the recording of this video. They're constantly changing it, so I'll put that little disclaimer in there. So what does it actually, I'm just going to show you some math, what it actually looks like here. So you turn 73 this year. You're going to take that number, corresponding number from the lifetime expectancy table, and that's going to be the divisor. You're going to take your account balance and divide it by that figure. So $500,000 balance divided by 26.5, which we took from our table, that means $18,868 needs to come out this year. I take the inverse of that typically, and I say, take your 500,000, multiply it by its 3.6, 3.7. That gives you that same number. That's an easier method for people to grasp. But here's what you need to know. When you're 73, you got to start pulling money out. There's no getting around it. If you don't, you get penalized. And it's a pretty hefty penalty. So make sure you're pulling that money out, and that number is going to go up as we age. I think when we're 120, the divisor is 50. So if you had $1 million in your IRA when you're 120 years old, you'd have to take out 500,000. That's a tax bomb right there. A bonus concept here, treasure chest. Qualified charitable distribution. All right, I'm going to use some acronyms. We just went over RMDs. That's required minimum distribution. This is a QCD. So if I say QCD, I'm talking charities, QCD, qualified charitable distribution. What we're talking about here, and here's a good example. This is Sam and Liz, and we work with Sam and Liz. If you know Sam and Liz, it's a different Sam and Liz because I changed their name, but this is a real scenario. Sam and Liz they're charitably inclined. They're in RMD, they're mid-70s, so they have to take their RMDs, and they don't need the money. They don't need it to live off of, and they like to give money to charities. So what we do for Sam and Liz is every year they give us a sheet of all the charities they want to contribute to. So we pull the money out of their IRAs, and it goes directly to the charities that they want to contribute to. They never take receipt of it. Two important things when it comes to this. Number one, what are you accomplishing? You're satisfying your RMD, while at the same time, that money is never hitting your tax return. So two things. You're giving to a charity, three things. You're giving to a charity, you're satisfying your RMD, and you are not paying tax on that money that came out of your IRA. Important follow-up here. Sam and Liz, they take their 1099-R from their IRAs to their CPA. And on the 1099-R does not say they did a QCD. So you or me or somebody needs to ask the question and make sure every year that we tell the IRS that was a QCD. Otherwise, this was all done for naught, and we're going to be paying tax on that money that came out of the IRA. So QCDs, pretty cool concept there. Sam and Liz. All right, capital gains is a rock here. And I'm just speaking specifically to one thing when it comes to capital. I mean, capital gains are cool. That means we made money. But I'm talking about something else. And what I'm talking about is phantom gains, mutual fund pass-through. Phantom gains. What's a phantom gain? That's when we owe tax because a mutual fund made a sale and we did not benefit from the gain on the underlying position. Here's what it looks like. You, me, you're watching this video and you think, man, it's my birthday and I'm going to invite Andrew to dinner tonight with me and 20 of my friends. So 19 of you and you're going to invite me. I'm number 20. We're going to go to a nice steakhouse. And unfortunately, I got stuck at the office. I had to rearrange my display case here because I like to do that from time to time. Also, people ask me sometimes, what's the coolest thing in the display case? There's a little jar up there. Top center. That is sand from Normandy. That's the coolest thing in the display case, in my opinion. All right, so 19 of you, one of me, we're going to dinner. I'm stuck at work. The 19 of you go, you get appetizers, you get wine, you get steaks. I roll in time for dessert. So I show up and I'm like, well, you already ate, but cool. I'll have dessert with everybody. So we eat dessert. It's awesome. And then the bill comes and there's 20 of us and it's $2,000, tip included, gratuity included. So that's easy math. That's $100 each. So to make things simple, we all say, Well, there's 20 of us, it's $2,000. So everybody throw in a $100 bill and we're good to go. So I paid $100. I didn't have steak. I didn't have wine. I didn't benefit the same way that the 19 of you did, but I pay the same amount. That is how a phantom gain works inside a mutual fund. To me, that's a knock on mutual funds. There are other more efficient vehicles. I'm not saying mutual funds are bad, but if you can create the same thing with a different fund structure, why wouldn't you? All right, here's some clients that came in. They came to a tax presentation of mine, just like the one I am delivering right now. They came to a live one and wanted to come chat with me and my team a few weeks later. And here was the situation. All right, this is Sally and Bob. And here's what we need to know about Sally and Bob. Sally's father passed away, and she inherited a bunch of stocks, and she let them sit there for a while, and then they grew, and then she had about $100,000 capital gain. And if you look at my chart here, that's Sally's $100,000 gain, and she's below my magical line of 126351. What is that line? That is the line that a married filing jointly couple over the age of 65 has to pay capital gains tax. You don't need to really follow the numbers here. You just need to follow the concept. If we sold all Sally's stocks that she got from Dad, she would not owe capital gains tax if nothing else was going on. But she had some things going on. Two things going on, one rock here and then a double rock over here that we turned into a treasure. Sally, Bob is already retired. Sally was going to retire the next year. And she said, I'm going to retire. I'm going to turn on my Social Security and I'm going to pull some money out of my IRA. And I said, okay, let's look at that from a tax perspective. Remember, everything we do, what are the after-tax implications? So her $32,300, that's her Social Security she was going to turn on. Next column, $32,300 Social Security plus $27,700 in IRA withdrawals. I said, hold on. I don't like this idea, Sally, because here's what's going to happen. You're going to be taxed on your Social Security. You're going to be taxed on your IRA withdrawals, and that $100,000 that we wouldn't have had to pay tax on, well, now that's going to push your column up there, and now some of that's going to be taxed as well. So you're getting a triple tax. Social Security, IRA withdrawals, and capital gains are all going to be taxed. So I said, let's hold off on the Social Security and the IRA withdrawals. What's that going to accomplish? Well, we can live off those capital gains. We're going to sell those stocks. We're going to live off that. We're going to keep your income under $126,351. That way you're paying 0% capital gains tax. Meanwhile, because your Social Security is paused, what happens when we pause Social Security? We all know this, it grows. What happens typically, hypothetically, in an IRA if we don't touch it? It grows when markets go up. We assume they go up over time. So what all did we accomplish here? How did we turn these rocks into treasure? Well, we were able to sell all those stocks, pay zero in capital gains, let the IRA grow for a couple years, and let Social Security grow, guaranteed about 8% per year. So we're saving on tax, we're letting Social Security grow, we're letting the IRA grow, and we're paying zero in capital gains. It was an awesome way to take some rocks that would have been forced upon Sally and Bob and turn them into 0% tax for a couple years there. All right, sequence of return. This is important for my retirees, not necessarily tax related, but here's what you need to know about this. This is, we think of our engineer. We have HP. We had this happened to a lot of HP engineers back in 2001, 2002. So this is starting at age 41. We're going to save some money. We're going to put away $100,000. We're going to let that grow till we're 65. My gray columns there, and my yellow columns, that's the exact same returns, but flip-flopped. Okay, same thing. And what happens at the end? Well, we averaged 8%, and our total in both scenarios is $684,848. Okay, it doesn't matter if we had positive returns in the beginning, middle, end. Those returns are the same. They average 8. We end up in the same spot. Now, we're going to retire from HP. This is where we get into trouble. Same returns, the gray and the yellow, same as before, exact same numbers. You can pause and go back and check that, verify that. But now we're pulling money out. So we're starting with $684,000, but we hit a few bad returns early on in the gray. In the yellow, we have awesome returns early on. What's the end result of that? Portfolio A runs out of money. My HP engineer runs out of money when he's 82 years old. Portfolio B ends up at age 90 with $2.6 million left. That's the law of the sequence of returns, and something that you need to be very aware of as you're rolling into retirement. Not tax related, but something I think is very important. All right, Social Security taxation. Is your Social Security taxed? Yes, probably so. And what is that number? Where does it come from? It comes from what's called provisional income, and I think the IRS has changed the name of that recently, but I'm old-fashioned. I'm calling it provisional income. And it's coffee break time. So what are the components of that? We take half of your Social Security plus your ordinary income, so that's wages or IRA distributions, pensions, whatever it may be, plus dividends and capital gains, plus non-taxable interest, aka muni bonds. We take that number, then we apply it to these thresholds, focusing on the bottom because that's our married thresholds. If that number is under $32,000, then our Social Security is not taxed. If it's between $32,000 and $44,000, half of our Social Security is taxed. And for most people, because these numbers have not been adjusted since the 90s, I believe, so most of us are going to be over. You can't live on less than $44,000 a year these days. Come on. So most of us are over $44,000, which just means 85% of our Social Security is going to be taxable. All right, slideshow just doesn't want to advance today. Here we go. Here's a scenario. This is why where you're pulling your money from matters. Column on the left, that's $90,000. Column on the right, that's $90,000. The big difference here is the column on the right has more Social Security. Column on the left has less Social Security. So that's important because the tax difference at the bottom is pretty significant. And the reason for that is we go back to our provisional income. So if we cruise through this on the left, we had more taxable Social Security. Therefore, our taxable income was higher, and the net result on the left was that our total federal tax was $5,000 versus on the right, where we kept our provisional income smaller, we only paid $305 in tax. So where you're pulling money from makes a big difference in the net tax that you have to pay. And we do have a little bit of control, not a ton of control, but we do have some control there. Medicare premiums, this is important. And I'm going to give you a cool example here. As you make more money, your Medicare Part B monthly premium goes up, as does your Part D, and it's pretty significant. So the cheapest, $349 per month, all the way up to about $1,200 a month for our highest income earners, just for Part B. So that makes a big difference. I know what you're thinking. I don't make $750,000 a year. That doesn't apply to me. Well, what if you're doing some Roth conversions? What if you're increasing that income? We see it happen a lot, and we always do that check when we're doing Roth conversions, because someone may arbitrarily say, I want to convert $100,000. And we say, cool, that all looks good. You're in the 22% tax bracket, but that's going to bump you into the next Medicare bracket. So maybe we don't want to do that much. Here's what it looks like for an actual client. Again, a rock that we turned into a treasure chest. So this is Perry. We work with Perry, and he's a single dude. And because he's single, he doesn't have anyone telling him that he can't go to Iceland for 6 months. So he said, I'm going to go to Iceland for 6 months. And he called and he said, I need just a little bit of money, $5,000 for my IRA. And I said, ooh, all right, Perry, let's put that on your tax map and see what that does to your tax situation. So see that spike in the middle? There's 3 spikes. One spike in the middle. That's Perry. There's a little dot left of that spike. That's Perry before his $5,000 IRA withdrawal. That other dot to the right of it, that's Perry after his $5,000 IRA withdrawal. So what happened? Highlighted down there, he pulled out $5,000. That was all fine as far as his marginal rate, but what he wasn't thinking about is that may spike, put him on the other side of that Medicare spike. So the tax per se is an increase to his Medicare premiums 2 years after the year that this happened. And that additional tax, Medicare premium increase, was $2,600. So that's over 50%. So he pulled out $5,000, and would have cost him $2,619, which would be over 50% tax when we look at it that way. Now, fortunately, Perry works with us, and we walked him through that and said, the cool thing is you have a Roth IRA, Perry. So we can pull your $5,000 from the Roth IRA. That's not going to hit the Medicare premium increase. IRMAA is what it's called. It's not going to hit that. So you're cool. We'll pull that $5,000 from your Roth IRA. NIT, this is a rock. This is just an additional 3.8% on capital gains. So I'm not going to go into that because it's pretty complex, and that's kind of 400 level tax planning. But just know that if you're married and you're making $250,000 and you have some capital gains, you're going to pay an additional 3.8%, something to keep in mind. Alternative minimum tax, we already went over this. We're going to call it a mandatory maximum tax. And there's a big, long equation that you run through to see if you're going to hit that or not. And then it's a flat tax of 26 or 28%. Things that will trigger it are large capital gains or incentive stock options. So if you have those, you may hit some AMT. All right, let's talk about an actual scenario here. This is Jane and John. Let's apply their situation to the real tax system, not just the 7 pool and the 3 pool, but look at other things that are going on. All right, they're married, filing jointly. They're over 65. They're blind. Look at them. They don't even have eyeballs, so they're definitely blind. They have $70,000 coming in from Social Security, $10,000 of capital gains. They were all phantom gains, so they didn't even do that on purpose. It came from a mutual fund. And $60,000 of RMDs, distributions that are coming out of their IRAs. So they have a decent chunk of change. Coming in was $140,000. They're over 65. So we would assume we just sort of plot them on this staircase, and wherever that $140,000 mark comes is what they pay in tax. But not the case. They actually ended up in my light gray staircase is their tax system, the real tax system. The dark gray below it is the basic tax system. They hit a 49.95% tax bracket in there. How's that even possible? We don't even have a 49.95% tax bracket. Well, here's what happened. They had an additional $1,000 IRA withdrawal. So we would think $120, 12% tax on that. But what actually happened is that caused $850 of taxable Social Security. $102 there, tack that on. Caused $1,850 of their capital gains to be taxed. $277.50, tax that on. Total tax from that $1,000 withdrawal, $499.50. Got to watch out for those things. RMDs push us into higher tax brackets, thus we pay higher taxes. So when we put the whole puzzle together, it's not always exactly what it seems. All right, widow's tax is a huge rock, something that you really, maybe one of the biggest takeaways of this presentation. Married filing jointly versus single filers. Here's what happens. Kelsey, my wife, and I, we're in our 70s, and we each have $1 million in our IRA. And my numbers that I'm saying don't match what you see on the screen, but it's the same concept here. We each have $1 million in our IRA, total of $2 million. We're taking RMDs. We're in our mid 70s. So we're married filing jointly, so we're paying married filing jointly tax rates. I kick the bucket, so I'm gone. Kelsey inherits my IRA. So we each had $1 million, pulling out our RMDs. It was hitting married filing jointly tax brackets. But now I'm gone. She inherits it. She now has a $2 million IRA or two $1 million IRAs, depending on what option she chooses. Either way, the RMD doesn't change. She has got to take the same amount of money out. She's actually going to have to take out more than we did the prior year when I was still alive. Now, the problem is that's going to hit single filers. So same amount of income coming in, but she's going to pay way more in tax. The scenario there on the slide has a difference of $7,000 or 7.9% tax to $12,700 or 13.8% tax. Same numbers, just hitting the single filing return versus married filing jointly. And so to cap all this off, and I'll throw up my disclosure slides. Here we go. Dear IRS, I would like to cancel my subscription. Please remove my name from your mailing list. There you go. Unfortunately, we can't do that, but a little joke there to wrap this thing up. All right, that's it. Take care. Hope you enjoyed it.